Michael Burry is known for The Big Short, but he will soon be known for The Big Short 2. Burry is currently betting on the worst financial crisis in U.S. history. That's right, we're talking about a collapse that is worse than the 2008 recession, the dot-com bubble, the Great Depression, and the Great Inflation. Burry is foreseeing the mother of all crashes, backed by the biggest decline in corporate earnings. The world is about to wake up to this crisis within the next few months, and Burry will once again make billions in the process. The past 13 years represented the largest bull run in U.S. history. The S&P 500 has increased by over 6 times in value since 2008. This unprecedented price increase was fueled by growing liabilities. Total public debt has tripled to over $30 trillion since 2009, and while it's impossible to know how much debt is too much, it's certainly not sustainable to keep adding trillions of dollars in debt every year. The growing debt balance is coupled with a massive decline in consumer savings. The U.S. personal savings rate is currently reaching levels that haven't been seen since 2008. Total personal savings have also declined through levels not seen in almost a decade. Despite inflation, the fact that total savings are declining while trillions of dollars are being added to the economy is extremely concerning. To make matters even worse, credit card debt is reaching all-time highs, signaling that the consumer is getting weaker and weaker every day. Michael Burry tweeted that U.S. personal savings fell to 2013 levels, the saving rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to pre-COVID peak. Despite all those trillions of dollars of cash drops in their laps, looming a consumer recession and more earnings trouble, the weakening consumer directly impacts the sales of companies. As the economy works with a circular flow, businesses and households transact in the factory market by exchanging labor for income. The other side of this is the product market, where households purchases products that businesses profit from. Because the households have weak purchasing power, this will cause the product market to experience lower activity. Lower consumption in the products market will lead to less corporate profits. Less corporate profits will lead the factor market to weaken, decreasing household income and weakening the products market once again. This is a positive feedback loop because one negative event could instigate an infinite downward spiral. Economists call this the circular flow model. As economic disasters at any point in the cycle are contagious, think about the circular flow model like dropping one drop of food coloring into a bucket of water. The entire bucket of water will be colored within a matter of seconds. Burry is giving numerical evidence as to why the lowering consumer sentiment will cause a depression. The reason why is that the low consumer activity will lower corporate earnings, decreasing household income and leading to even less saving. Burry reiterated his statement by showing the downwards trend of the U.S. personal savings to GDP, charting total U.S. personal savings GDP. Red line has the all-time low at 1.5% set in July 2005. At the last 12 months rate of depletion of savings could hit that level between September and December this year. Borrowing time attached to the tweet is a graph showing a cyclical decline in the personal savings to GDP ratio. Burry is clearly calling for a consumer-led recession, but he's not the only one saying that. Federal Reserve Chairman Jerome Powell once said in 2019 that he was very worried about the growing U.S. debt. The total U.S. debt back then was roughly $22 trillion. That number has now increased to over $30 trillion, which is a 36% increase in 3.5 years. All of this is concerning, but you might be wondering what degree of a collapse we're talking about here. Prominent economists worldwide often compare our situation to the 1970s, when the US experienced inflation in the double digits. The 1970s is often seen as a period of stagflation because the economy simultaneously experienced high unemployment and high inflation. This period of time coincided with the record increase in the misery index due to low consumer purchasing power. Imagine a period in which you not only become unemployed but also witness your money become worthless. That might seem frightening, but Burry actually believes that our current situation is magnitudes worse than the 1970s. Michael Burry explained how some compare the US of today to the 1970s, but the 1970s saw rapidly growing labor force participation due to the post-World War II baby boom. We have the opposite today: birth rates at 1950 levels and nuclear families at 1959 levels. Despite a 2 times larger population don't help. The reason why Burry refers to our current situation as the opposite of the 1970s is because of 2 factors: the labor force participation rate and the birth rate. The 1950s is known as the baby boom because the fertility rate increased dramatically. This drastically increased the labor force and therefore allowed for increased economic activity in the 1970s. Topped this off with a rapid increase in the labor force participation rate, and the situation wasn't as bad as it seemed. Our current position is the opposite of this. Even though we have a population size that is 2 times larger than the 1970s, we have a birth rate that is half of that of the 1950s. Not only that, but the labor force participation rate is just continuing to decrease over time due to the Great Resignation. The Great Resignation was a period that started in the spring of 2021 when a huge influx of U.S. workers began quitting their jobs. The reason for these resignations included low pay, no advancement opportunities, disrespect, and a myriad of other reasons. So the 1970s was a horrible time with significant social unrest. But imagine what will happen in 2022. When we have both stagflation and an incredibly weak labor market. Burry tweeted an article that stated the parallels between the 2020s and the 1970s grow more numerous by the day. The economy faces the threat of stagflation, fuel prices are surging and shortages loom, politicians are flailing, the international environment is deteriorating, the Supreme Court is revisiting the 1973 Roe v. Wade ruling, the homicide rate is soaring amid a general sense of social breakdown. The article pointed out 7 similarities between the 1970s and today's: stagflation, fuel prices, shortages, political turmoil, geopolitical tension, Roe v. Wade, and social breakdown. Burry is showing this article in order to show how our modern crisis is essentially the 1970s but much worse, and despite focusing on the 1970s, Burry actually sees characteristics in every single U.S. crisis in our current situation. He joked around by saying that a band named Slipknot started shooting the generals in September 2000, January 2008, and April 2022. While Burry was joking about Slipknot's music videos, he certainly believes that our current bubble is the mother of all bubbles. He once tweeted in late 2021 about how we have more speculation than the 1920s, more overvaluation than the 1990s, more geopolitical and economic strife than the 1970s. Players grabbing the barrel of Kyle Rittenhouse's rifle while the Second and Federal Reserve not approvingly. In addition to describing the similar characteristics to other crises, Burry has also publicly called the current bubble the greatest speculative bubble of all times in all things by 2 orders of magnitude. But even though the economy is in a poor position, a strong government body can help alleviate some economic and social concerns. This has not been the case with President Joe Biden. The vast majority of economists have complained about how Biden has been exacerbating government debt issues through high fiscal spending. Biden's budget has totaled to an amount of $5.8 trillion, which is over 25% of the total U.S. GDP. This level of spending during an inflationary period is simply going to intensify our current crisis. Burry complained about Biden's fiscal spending by wishing a real potato was president. Some will say that the dollar index is increasing and this means that the US dollar is in a strong position. However, the dollar index compares the US dollar to other fiat currencies. Fiat currencies are government-backed currencies like the Chinese yuan or the Russian rubles. Because we're in a global crisis, comparing the US dollar to other international paper currencies is meaningless. Where we warned about this by saying, when you see mention of the strong dollar, the almighty dollar, please remember this is only in relation to other fiat currencies. The dollar is not at all strong and it is not getting stronger. We all see it every single day in prices of everything. In other words, the US dollar is strengthening in comparison to other fiat currencies, but when it's compared to actual items, the dollar is getting weaker and weaker by the day. Michael Burry's macroeconomic thesis is quite clear, but not many will actually listen to his warnings. One investor who didn't listen to Burry before the 2008 recession was Warren Buffett. Buffett later regretted this and publicly stated that he should have considered Burry's hypothesis. Michael Burry believes that this will happen again and tweeted a video where Buffett called him Cassandra. Cassandra is a Trojan priestess in Greek mythology that told true prophecies that nobody ever believed. Buffy called Burry Cassandra because Burry was telling a true prophecy that everyone ignored. Congress, but don't we expect referees to make the call even if they're going to get booed? Yeah, and they made the wrong call. I mean, they basically believed that most of the American public didn't, and you couldn't have had this size bubble without overwhelming, and the Cassandras were there. But who was going to listen to John Paulson in 2005 or 2006 or Michael Burnham? And it didn't mean anything. Burry had bets against the market that allowed him to make billions in the 2008 recession, and he also has those bets right now. While he does profit on market crashes, Burry doesn't enjoy doing so. As I said about 2008, it is like watching a plane crash. It hurts, it is not fun, and I'm not smiling. So now we know that Burry is predicting a market crash so large that it could lead to the Big Short too. But with that being said, how will Burry profit on the incoming market crash? According to his second filings, he is purchasing shares in stable inflationary resistant companies. This includes $20 million in a pharmaceutical company named Bristol Myers, roughly $18 million in both Facebook and Google stock, and a variety of other companies in a similar strong position. The two key similarities between these companies is a strong moat and significant pricing power. Having both of these factors will allow these companies to raise prices during an inflationary period. While crushing the competitors, Burry also recently revealed that he has a put option on $35 million worth of Apple stock. This is likely a hedge against his Facebook and Google position, as Apple will have to deal with increasing material costs while Facebook and Google do not. But more importantly, Burry likely has a substantial short position in the bond market, which he doesn't have to disclose to the public. I covered this in a previous video that can be found in the description. Michael Burry is once again preparing his portfolio to profit immensely in the coming months, and he might just make billions once again. Let me know what you think about Burry's short thesis down below. How are you preparing for a potential market crash? If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.